The Managing Director of Kotak Bank, Uday Kotak, spoke on the sidelines of corporate governance concerns. Here's an excerpt of his interaction.
The principle today in the world from a saver or an investor perspective, friends, is return of capital is more important than return on capital. So in a world which is in this mindset, where there is reasonable risk aversion, what does India need today from the point of view of our growth? What India needs is risk capital. We need savers not only from across the world, from within India, to be putting money into risk assets. And this is where I think we should start thinking of corporate governance not only from the lens of what we need to do to improve corporate governance, but from an output and outcome orientation that if we need risk capital, what are the consequences of lack of corporate governance? Because we will not get it. And if you look at the traditional Indian saver, he or she was basically investing in two assets: gold, real estate. Gradually, that saver began to move into fixed deposits with companies. Then, thanks to the development of before that, fixed deposit companies, then in life insurance policies, then thanks to the development of SEBI into non-convertible debentures, into equities and equity mutual funds and debt mutual funds. So we have seen the evolution of the traditional Indian saver move from so-called real assets of gold and real estate into financial assets. And this has been a journey over a long period of time. And we have gradually moved this saver to be taking some risk. In recent times, friends, the events, especially in many parts of corporate India, the saver is beginning to get worried about the nature of his money, including in debt instruments. We have seen fixed deposits go under. We have seen debentures get into trouble. We have seen corporate sector and financial sector not being able to honor its commitments in some cases. And therefore, the saver and the investor is beginning to get more cautious. And so also the intermediaries. I think one of the greatest developments which has happened in the recent years is the development of the mutual fund industry, particularly the equity mutual fund industry. So if I'm not mistaken, spreading beyond the main urban centers into smaller centers happened when Mr. UK Sinha was the chairman of SEBI, and he expanded the role of mutual funds to go into deeper parts of India. So getting the saver to participate in risk capital and capital formation of the country. And this was a very welcome development. But when we do this, when we start getting the savers and investors' money into this category, there's a heightened responsibility of society, regulators, all fiduciaries to ensure that this money is well taken care of. And in this background, friends, we have to figure out what is the reason for such a huge amount of risk aversion which has come into the Indian system. And this risk aversion doesn't just stop at investors. We have finally got investors to put money in SIPs. So every month, more and more money is coming into SIPs. But this risk aversion has gone into the minds of the fund managers. They are buying more and more of 80, 90, 100 PE ratio stocks rather than going out there and moving to small caps, mid caps, broader markets. Why? It is fear that something may be in those companies which we do not know. We don't necessarily trust the numbers. We don't necessarily trust the group company transactions. We don't necessarily trust what the board of directors of those companies may be doing. So this lack of trust is leading to an outcome of a risk aversion. And you have to ask, why is it that the fund managers, or even most of us, why is it that we are just making our capital market so narrow that it's only 10, 20, 30 stocks which are getting the so-called risk capital which is coming in? And this is something which we need to correct. Therefore, it is not about, we need to improve the levels of governance, which is obvious, which is the input side. The problem is the outcome and the risk aversion which is happening in the Indian society. I will put another point in that context. Let us talk about non-listed companies. India is scarce on risk capital. The financial savings pool is growing, but risk capital pool is not growing. Private equity industry in India, almost non-existent. Any form of private equity, it is a global foreign player. Indian savers don't want to put money in private equity, and the outcomes in many cases have also been poor. So if somebody has put money with a 5, 7, 8-year horizon into private equity in India as Indian savers, it has not necessarily given the returns as expected. So what does it take to build the risk capital, private equity industry from domestic savers is another question we need to ask. And in that context, of course, we want to push startups, we want to push growth of SMEs, but fundamentally there is an issue. Historically, SMEs got funded, if I may use the word, by banks with quasi-equity, with all the risks of equity, but all the upside going to the owner, which is what banking did. It gave quasi-equity capital and took all the downside. And we have seen the results of how banking has suffered as a result of this. So how are SMEs going to get capital, risk capital? If governance, and therefore the governance issue is not just about public companies or larger unlisted companies,